So now in chapter 3, we're getting into the kind of the nuts and bolts, if you will, of personal finance. So again, money management strategies, financial statements, and budgeting. So recognize the relationship among financial documents and the money management activities. Daily spending and saving decisions are the main element of financial planning. Again, daily, meaning that you do track this on a daily basis. You track your finances on a daily basis. This is critical. Decisions must be coordinated with needs, goals, and personal situations. Again, factoring all these things into that decision-making process, what your needs are, what your goals are, what your current personal situation is, what is it going to be kind of going forward. So again, money management is a day-to-day financial activity. It's necessary to manage your current personal economic resources, again, with the objective of long-term financial security. This is what we're always looking forward, where we're at right now, and how it fits kind of going forward. So we recognize the relationship among financial documents and money management activities, how they kind of tie in together. So opportunity cost and money management, we're talking about, there's a very, very high opportunity cost associated with savings. So remember, when I say trick yourself by paying yourself first, when we think about flipping the script so far as income is concerned. So income goes to 3 places. It goes to taxes, consumption, and whatever's left over goes to saving. So when I say flip the script, try to save first, meaning set it aside first, and then develop your budget from after that point, meaning, pay your taxes, and whatever you have left over is for consumption. This is kind of the thought that we have and that you want to keep in mind, is that, again, so we're looking at, our current living expenses, for example. We want to know what those expenses are and how can we reduce that in order to save and in order to invest. Things of cautionary tale: buying on credit ties up future income, because just because you have something that you purchase, but the problem is, of course, you will be paying for this, going forward. Using your savings for purchasing results in lost interest earnings and depleted savings. So there's always opportunity cost. There's a cost involved with any of these things. Remember what we're looking at, and it's not that you want to deny yourself to the point where, you're starving or you're this or that, but just keeping in mind that oftentimes when we kind of forget this is that when we're saving something, we just see the downside. The upside is that we are actually doing what? We're actually setting aside money for our future self. So when in doubt, again, comparison shopping can save money, but it takes valuable time, meaning that we know that we do have to think about these things. We have to consider these things, but we have to also be cautious of how much time we're actually spending on doing these things. Okay. So the steps involved are, again, we're so anyways, what I was trying to get at was that when we're looking at financial records, for example, we want to make sure that they're that we handle them in the appropriate manner, meaning that we categorize them, we catalog them, and we're keeping track of these things, right? So handling, these daily things on a daily basis, right? Our budgeting and so on and so forth. So we're planning and measuring financial progress as we go, keeping required tax reports and making effective investment decisions. All these things kind of roll together, if you will. So things that we want to keep in our own, making sure that they're safe. Tax records we have to keep those for 7 years. An example of going above and beyond is that keeping paper records. It's not necessary to keep lots and lots of paper records. In the past, the brother of mine, my brother, had financial records, credit card statements going back for 30 years. Not necessary. What I mean is that not that you're ignoring, it's good to kind of keep records, but oftentimes today we can find things online. We don't have to necessarily have the paper copies of pretty much everything that's out there. Nonetheless, there are things that we do want to make sure that we keep track of, paper records, if you will, such as when you purchase a home, for example, or if you have some insurance information. Think about it like in terms of your passwords, meaning you want to make sure that you're keeping track of these things, but at the same time, what is worth kind of hanging on to? What is worth? What is the value, for example, again of back to what I said about your credit card records going back several years. It's not really necessary to keep those things, but nonetheless, there are a lot of paper records that we want to keep, and including like estate planning records and wills and so on and so forth. So where do we keep records? Safe deposit boxes. These are kind of passé. Most banks are kind of shutting a lot of these access down. People would keep records like paper copies of such things as Social Security cards and different things of value that are they want to make sure that they're safe to the point where no one else can access except for them, which is not a bad idea, but it's kind of tough to kind of get into a bank on a Sunday afternoon to take a look at your rare coin collection, for example, copies of wills and so on and so forth, things you can keep on your personal computer, on a flash drive, different things like that. Where you store them on your computer or in the cloud, etc. How long do we keep records for various things? We hold on to marriage certificates, birth certificates, wills, etc. We want to keep those, permanently, if you will. But taxes, for example, we're on the hook for 7 years for tax returns. So keeping these things in mind. Right? Now, moving into the realm of financial statements, the first thing we're going to be looking at is a balance sheet, this idea of a balance sheet. The main purpose of these financial statements is to kind of keep track of where your financial activities are at and so on and so forth, right? This is like the objective or the point of having financial records. So the two different types of financial records, two basic ones would be a balance sheet and also an income statement or a cash flow statement. So a personal balance sheet, this is a snapshot of where you're at right now, meaning your assets and your liabilities and whatever's left over is your net worth. Meaning, quick example would be you have a home. So you purchased a home and the value of the home is $200,000. You put 20% down, so you own $40,000 of that $200,000 home. So the value, the asset is worth $200,000. The liability is that $160,000 that you owe, and then what's left over is that down payment of that $40,000. So you own $40,000 worth of that home. So that would represent your balance sheet as it is with that home itself. So the asset would be the home, the liability would be how much you owe on the home, and the net worth is what's left over, again, that $40,000. So something to keep in mind is that when we talk about wealth versus income, wealth is what you currently own, your assets minus liabilities, a snapshot, whereas an income is how much you earn over a period of time. And your net income or profit or loss is what you have left over after what? After you pay taxes, after your after what you consume, and you would have your savings that would be left over, but net income would be after you pay your taxes, whatever you have left over. So in developing a personal balance sheet, if you will, you look at your assets, what your assets are, and you look at it, you move it from whatever's most liquid to the least liquid, if you will. Meaning liquid, meaning how quickly you can turn that into cash. So the cash that you have would be a very, very liquid asset. Your checking account, your bank, your savings account, versus the home that you own, versus some personal possessions, versus some investment assets, which would be, they're pretty liquid, but nonetheless, if you have a 401k, you typically would not be able to, or should not at the very least, should not be accessing until you reach a certain age. Otherwise, there's a significant tax issue that comes up. So that's the first step, listing these items. Second, determine the amounts owed, so the liabilities that you owe on that home. Again, current liabilities would be less than 1 year, and longer term liabilities, that home example, would be for a longer period of time. Computing that net worth is equal to assets minus liabilities, or equity is equal to assets minus liabilities. So assets are equal to liabilities plus net worth. Insolvency is the inability to pay off, or insolvency rather, again, is the inability to pay off debts when they are due. So these are all kind of things to kind of keep in mind. So again, when we talk about net worth, we're looking at what it is that the snapshot of what your current position is. So how do you increase your net worth this is where the income part comes into play, where you increase your savings. So again, when we talk about income, or that cash flow, if you will, the income is your income goes to three places: goes to taxes, consumption, and saving. Whatever's left over, the residual. Again, we want to flip the script on that, but nonetheless, that residual, whatever that saving is left over, that would be added to your net worth. Or if you're spending beyond, that would be taken from your net worth. Okay, so keeping that in mind. So the objective, of course, is to do what? Is to reduce that spending as much as you can, and to have as much left over for saving as possible. So calculating your net worth, again, is pretty straightforward. We talked about a home. You have $193,000 worth of assets, that home being worth $193,000, and liabilities, outstanding liability, how much you owe on that home, of $88,000. The residual, whatever the left over portion, is going to be $105,000. So assets minus liabilities equals the net worth. So your $105,000 equates to your net worth, right?